Equity markets have hit new highs this year, but there is still a substantial amount of cash on the sidelines. Joining us now to discuss what investors should be thinking about heading into 2025 is Jing Roy, VP Director and Portfolio Manager for Asset Allocation at TD Asset Management. Jing, so great to have you on the show, particularly as we get ready in the next couple of days to say goodbye to the trading year.
Well, thanks for having me. I get to have the last words.
You get to have the last word. You are the last live guest of the year. Let's talk about the year that we had. Some people have taken a look at the run we've had. I was talking about the new highs, both here on Bay Street and Wall Street. A bit of a surprise, but definitely a strong year for equities.
It has been a phenomenal year for equities. In fact, the S&P 500 index made 58 new highs this year. So when we look at the returns for Canadian investor who had locked in a GIC at the beginning of the year at 4%, they would have missed out on a 40% US equity return. And a quarter of that actually came from US dollar strength. So in Canadian dollar terms, cash underperformed virtually every single asset classes globally. So it's very important to be cognizant of the fact that there's a cash drag. It's very real.
I mean, yeah, it seems like a disconnect, doesn't it? You're looking at these markets that have had a great run this year on both sides of the border, yet so many people still sitting in cash. To me, that speaks of an almost hesitancy to believe in the market rally.
Yes, I think what surprised the investor is the potency of a synchronized global rate cut cycle and the resilience of the U.S. economy. And of course, we have this transformational innovation happening in the technology sector.
So a lot of interesting things in 2024. Still got a couple trading days ahead of us before it's all over, but before you know it, we're going to be into 2025. Outlook for equities next year.
So we're very constructive on risky assets for 2025. It's very hard for cash to compete against risky asset returns because right now GIC is yielding 3%, and before we know it, by the end of the year, it could be with a 2 handle because of the Bank of Canada rate cuts. So starting from equities, as a baseline, investor would require 5% extra return over risk-free rate to be enticed to hold equities. So in this rate environment, we will expect 9% equity return to be the bar for investors to consider equity allocation. So for US, we expect low double-digit equity return this year, and that's really supported by very strong earnings growth from the S&P 500 index. We expect earning growth to accelerate from 12% next year, from 9% this year. And if the diffusion of the AI acceleration to the medium-term growth outlook from digital infrastructure investment and productivity enhancement, then we can see investors willing to pay even more for future earnings. Because the rates are coming down, investor will have to think about how to get yield. Then there's always the opportunity to reach for yield in the equity market, and that's a positive for Canadian equity markets, where we have banks and utility companies and pipelines yielding mid-single-digit dividend yield. So that's a plus for Canadian equity.
Now, when it comes to equities next year, that is your base case for more gains. At the same time, even in a bull market, stocks don't go up just in one direction. Would we be surprised? I know we can't time the market, but would we be surprised if we saw a bit of a pullback at some point?
Yes, the valuation is a little higher than the norm. But we have to put that into the perspective of a revision to higher medium-term growth rate. So if you look at the equity risk premium, it's at very reasonable level of 4.5%. So if the growth outlook doesn't disappoint, then I think we have every opportunity to buy the dip.
Okay, let's talk about the fixed income side of this in terms of what we might expect from the bond market in 2025.
So the all-in yield from bonds are actually very attractive compared to cash and inflation. So for 2025, we're more bullish on corporate credit than government bonds. And the reason is that the economy remains resilient and the corporate balance sheet are very strong. Corporations have the will and the means to pay, to service their debt, and have very little trouble to roll over their debt because of structural demand from insurance companies savings and pensions. So, in terms of in a falling cash yield environment, corporate credit is really a good alternative for conservative investors looking to lock in that stable long-term income. So for 2025, we expect fixed income credit return to be commensurate with a coupon return. So that means about 4.5% for investment grade credit, about 6.5% for high yield. In the event that economy start to sputter a little bit.
I was going to ask you about the risk here. What's the risk for corporate credit?
Yes, in the event that economy start to disappoint a little bit, we would expect long bonds to be a diversifier for equity drawdowns. So we'll remain tactical on duration.
Okay, we put that all together for the year 2025. We start talking portfolio construction. What do investors need to think about with all that cash still sitting on the sidelines?
I think one of the well-kept secret is that, asset allocation, which means how much money an investor put into each asset class, really is the most important decision you can make when it comes to investment returns. So there are two extremes. Let's think about at one extreme, a very aggressive investor who would shrug off a 20% equity drawdown and will allocate 100% of its portfolio to equity to get 40% return this year. On the opposite end of the spectrum, a conservative investor will get crushed if he had a 5% loss and be very happy with 3% cash yield. The truth is that most of us are somewhere in between. As a result of that, it's very important for asset allocator like us to curate the good investment strategy and find the asset mix that can optimize the return and tailor to every single individual investor's risk tolerance level. So let's talk about cash. Cash is really a poor man's solution to volatility and uncertainty until now. Today, we actually have access to a wide range of asset classes and strategies that can help us manage the volatility. And those strategies used to be the exclusive purviews of sophisticated pension funds and institutional investors. So I'll give you a few examples. Number one, we can now buy equities with limited downside because of the portfolio insurance we purchase. We also have private mortgages, which is yielding 200 to 400 basis point of yield pickup with very little interest rate exposure. And we also have access to long-short strategies whose return is very uncorrelated with the broader market. So putting these all together in a portfolio, they lower the risk of the portfolio just as cash does. But more importantly, they allow investors to turn cash into capital and able to compound returns at a higher level over time.